Ladies and gentlemen, somewhere inside a marble building in Washington, a handful of people are about to make a decision that could quietly reshape the value of every ounce of gold and silver you own. Almost nobody outside the financial world will understand why until it's already happened. This isn't an exaggeration. It's happened before more than once, and the pattern shows up so consistently that economists have traced its fingerprints across 5 decades of market history. If you own physical metal, or you're thinking about buying some, or you've been sitting on the sidelines wondering if you missed your window, what you're about to hear could be the difference between reacting emotionally when the headlines break and knowing ahead of time exactly what to watch for. Federal Reserve decisions aren't really about interest rates. Interest rates are just the visible surface. Underneath sits something almost nobody in the mainstream financial press bothers to explain properly: the real interest rate, which is what you actually earn on your money after inflation takes its cut. That one quiet, technical number has explained more about gold's major turning points than almost anything else in economics. Stick with this, because by the end you'll understand something that separates people who see these moves coming from people who just get whipsawed by them. Go back to August 1971. President Nixon stood in front of television cameras and announced that the United States would no longer let foreign governments exchange dollars for gold at a fixed rate. It was framed as temporary. It wasn't. It was the end of the Bretton Woods system, the arrangement that had anchored the global financial order since the end of the Second World War. Overnight, the dollar became a pure fiat currency, backed by nothing but the credibility of the U.S. government. Gold, pegged at $35 an ounce for decades, was suddenly free to find its own price in a world where money itself had lost its anchor. What happened next isn't what most people remember. Gold didn't spike and flatten out. It climbed in waves, tied to what was happening behind the scenes at the Federal Reserve. Through the 1970s, inflation surged into the double digits, and for long stretches, the Fed kept interest rates below the rate of inflation. That gap is what economists call a negative real interest rate. When real rates go negative, holding cash in a bank account is, in effect, a guaranteed way to lose purchasing power every year. Gold costs money to store and pays no interest at all, and yet it becomes relatively more attractive anyway, because the alternative is quietly bleeding value in a way a savings account statement never shows you. By 1980, gold had run from $35 an ounce to over $850 at its peak. That's documented market history, not speculation. It wasn't magic either. It was the traceable result of a decade in which the Fed, under Chairman Arthur Burns, let real rates sit negative year after year, effectively subsidizing anyone willing to hold hard assets instead of cash. Then Paul Volcker took over in 1979 and did something almost unthinkable at the time. He pushed rates above 20%, deliberately triggering a recession to crush inflation. Real rates flipped from deeply negative to sharply positive, and gold's decade-long run ended almost immediately. Not a coincidence. The mechanism, in its cleanest form, we're not in the 1970s anymore, but the underlying relationship between what the Fed does with rates, what inflation is doing, and what that means for the real return on cash hasn't changed. It can't change. It's baked into the arithmetic of money and inflation. What has changed is the complexity of the modern financial system, the sheer scale of global government debt, and the number of moving parts an ordinary investor now has to track just to understand what one Fed meeting actually means for the metal sitting in a safe or a safety deposit box. Most financial coverage of a Fed decision focuses on the headline: did they cut, hold, or hike? That misses almost everything that actually moves gold and silver. What matters first isn't the decision itself, but the guidance, the forward-looking language about what the Fed expects to do in the months ahead. Markets price things in advance. By the time a decision is announced, much of it has already been absorbed through weeks of speculation, data releases, and comments from Fed officials. What actually moves prices is the surprise, the gap between what was expected and what was delivered, and any shift in the tone of that forward guidance. Second, and rarely explained well, is what's happening to the dollar. Gold and silver are priced globally in dollars, so when the dollar strengthens against other currencies, it takes fewer of those stronger dollars to buy the same ounce of gold. That alone puts downward pressure on the metal, even with nothing else about the economic picture changing. When the Fed signals higher rates for longer, it typically strengthens the dollar because higher rates pull in foreign capital chasing better returns on dollar assets like Treasury bonds. That inflow strengthens the currency, and a stronger dollar tends to pressure gold and silver lower, even during periods of real uncertainty. Third, and arguably most important for anyone holding metal long-term, is the real yield on the 10-year Treasury note, the yield after subtracting expected inflation. Decades of publicly available market data point to this as one of the strongest inverse relationships gold has. When real yields rise and bonds start paying a genuinely positive return after inflation, gold looks less attractive by comparison since it pays no yield at all. When real yields fall or go negative, gold's relative appeal jumps because you're no longer giving up much by holding an asset that generates no income. Since 2022, The world has lived through one of the most aggressive rate hiking cycles the Fed has run in more than 40 years, a direct response to the sharpest inflation spike since the early 1980s. That spike came from a mix most people lived through: directly enormous pandemic-era stimulus, historic supply chain breakdowns, and an energy price surge tied to the war in Eastern Europe. The Fed's answer was to push rates from near zero to levels not seen since before the 2008 crisis, trying to drag inflation back toward its 2% target. And yet, gold didn't collapse the way the textbook relationship would predict. It pushed to a series of record highs during that same stretch. If higher real rates are supposed to hurt gold, why would that happen? Because a second force was building underneath it, one that barely existed in Volcker's era: central bank buying on a historic, coordinated global scale. According to the World Gold Council, central banks around the world, China, Russia, India, Turkey, and a number of others looking to reduce their dependence on the dollar for reserves, have been buying gold at a pace not seen in the modern data record, with several straight years of demand exceeding 1,000 tons annually. That's not casual accumulation. That's deliberate positioning by sovereign institutions, thinking in decades, not quarters. A lot of economists tie this to a broader trend, usually called de-dollarization, a slow, uneven move by several nations to reduce how much global trade and reserves depend on one currency controlled by one country's monetary policy. Hold on to that thread because it comes back later, and it has nothing to do with the real yield relationship at all. It's a geopolitical story sitting on top of a monetary one, and you need both to actually see what's coming. There's a second thread that leads straight to why the next Fed decision carries so much weight: government debt, and the corner it's backed the Fed into, whether officials say so publicly or not. U.S. federal debt has crossed well past $35 trillion, and according to Congressional Budget Office projections, the interest expense on that debt alone, just the cost of servicing what's already owed, has become one of the fastest growing line items in the entire federal budget. Economists sometimes call this fiscal dominance, a situation where the scale of government debt starts to constrain what a central bank can realistically do with rates, regardless of what inflation data alone would suggest. Here's why it matters for anyone holding metal. Keep rates high long enough to fight inflation, and the interest bill on that debt keeps growing, adding pressure on the government's own finances. Cut rates too soon, before inflation is actually under control, and you risk reigniting the same price pressures you spent years fighting, which is more or less what happened in the late 1970s when the Fed cut prematurely more than once and watched inflation come back worse. That's the stop-go pattern, and every Fed chair since Volcker, Greenspan, Powell has had to publicly reckon with the lesson of that mistake: cut and risk inflation returning, or hold and risk an unsustainable debt service burden. That tension is exactly the kind of high-stakes balancing act that tends to produce outsized market moves the moment a decision is announced, which is why gold and silver so often see some of their sharpest single-day swings in either direction right after these meetings. The market isn't pricing in a number. It's pricing in which side of that dilemma the Fed seems to be leaning toward, and how that lean might shift over the following months. Before going further, worth pausing on something important, because none of this should be dressed up as certainty. No analyst, no economist, no central banker can tell you with confidence what the Fed will do at any specific upcoming meeting, or exactly how gold and silver will react in the days after. What history gives you is a way to understand the mechanism well enough to read whatever happens with more clarity than someone just reacting to a headline. That's really the whole point of walking through this history at all. Silver behaves differently than gold, and the difference matters. Gold trades almost entirely as a monetary and store of value asset. Silver is a hybrid. It carries substantial industrial demand, used heavily in electronic solar panel manufacturing, electric vehicles, and a range of other applications. For the Silver Institute, industrial use now accounts for the majority of annual silver consumption, a demand profile nothing like gold's. That pulls silver in two directions during major shifts. When a Fed decision signals slowing growth, industrial demand for silver can soften in a way that gold, as a purely monetary asset, doesn't experience. But when the same decision signals negative real rates or currency debasement worries, silver often reacts even harder than gold on the upside, something traders sometimes call the leverage effect. Silver's total market is far smaller than gold's in dollar terms, so it often takes less capital to move its price by a bigger percentage in either direction. That's why silver has shown more volatility than gold in nearly every major precious metals cycle on record, including the run-up in the late 1970s and the surge after 2008. On 2008, when the financial crisis hit, the Fed slashed rates to near zero and, for the first time in its history, launched large-scale asset purchases, quantitative easing, expanding its own balance sheet by creating bank reserves to buy treasuries and mortgage-backed securities. A lot of economists at the time warned this would trigger runaway inflation given the scale of the expansion. That inflation didn't fully show up in the following years. largely because the new money stayed concentrated inside the banking system rather than flowing broadly through the economy the way it would over a decade later during the pandemic stimulus. Gold still rallied hard through that stretch from around $700 an ounce in 2008 to over $1,900 by 2011 if consumer inflation stayed fairly subdued. Why? Because the driver wasn't headline inflation. It was a collapse in confidence, a broad reassessment of what fiat currencies backed by expanding central bank balance sheets were actually worth, combined with real rates pinned near zero or negative for years. Worth remembering, gold doesn't just respond to inflation as measured by government statistics. It responds to the market's confidence, or lack of it, in the monetary system itself, which is why gold sometimes rallies even when the official inflation numbers look tame. If this kind of breakdown is helping you see these markets more clearly, take a second to like the video and subscribe. Digging into the actual mechanism instead of repeating headlines is what this channel is for. And genuinely curious, down in the comments, are you holding physical metal paper exposure through a fund or still sitting on the sidelines deciding? The reasoning behind each of those tends to be pretty different, and it shapes what we cover next. Back to where this is heading. Pull the threads together and the picture gets urgent for anyone holding metal right now. The Fed is caught in the fiscal dominance bind described earlier, weighing the risk of reigniting inflation against a growing debt service burden. Central banks are in the middle of a historic, multi-year accumulation of physical gold, a trend a lot of economists connect to that gradual move away from total dependence on the dollar as the world's reserve currency. Real yields have moved through several distinct regimes in just a few years, negative, then sharply positive as the Fed hiked hard, and now sitting at a level plenty of analysts are watching closely for the next shift. And government debt, along with the interest burden attached to it, sits at a scale that's never existed before in the modern era of Fed policy. All of that is why the next Fed decision, whenever it lands, carries outsized weight for gold and silver holders. It's not just a rate decision on its own anymore. It's a signal about which side of the fiscal dominance dilemma the Fed is leaning toward, a data point that either reinforces or challenges the ongoing de-dollarization trend, and a shift in real yields that strengthens or weakens the appeal of holding a zero yield asset against interest-bearing alternatives like treasuries. One distinction worth holding on to well past this particular meeting: when the Fed cuts rates because inflation has genuinely been tamed in a healthy economy, gold's reaction tends to be muted, since falling rates in a strong economy usually just send money into equities instead. But when the Fed is forced to cut because growth is deteriorating fast, a policy response to recession risk rather than a victory lap over inflation, gold has historically responded far more powerfully because that combines falling real yields with an actual flight to safety. Whether a rate cut comes from success or from stress tells you a lot more than simply whether rates went up or down. Same logic in reverse. If the Fed holds or raises rates because the economy is genuinely strong and inflation is stubborn, that tends to strengthen the dollar and pressure gold short term, echoing the Volcker pattern. But if rates stay high specifically because the Fed fears inflation expectations coming unanswered even as growth data weakens, a far more uncomfortable spot for policymakers. The closer parallel is the late 1970s stagflation period, slow growth and high inflation at the same time. Stagflationary stretches have historically been among the strongest environments for precious metals on record because they combine negative real yields with a broad loss of confidence in monetary stability, both at once. Which brings the fiscal dominance thread full circle. If it eventually forces the Fed's hand toward rate cuts simply to manage the government's own debt service costs, regardless of whether inflation is actually tamed, a number of economists point out there's no clean historical precedent for that scenario at this scale of debt. That's exactly why so many analysts are watching this dynamic more closely than almost anything else heading into future Fed meetings. So what does this actually mean if you're sitting there holding gold or silver? Or thinking about it, stop watching for one headline number and start watching three things underneath it. Watch the dollar index, since its direction tells you about capital flows and global demand for dollar assets. Watch real treasury yields, since that single relationship explains more of gold's major moves than almost anything else. And watch the Fed's language about future policy, because markets move on what's expected to come next more than on the decision that's already been priced in. Gold and silver were never simple bets on inflation or simple bets on fear, whatever casual commentary suggests. Across 50 years, Bretton Woods collapsing, Volcker's inflation fight, the 2008 crisis, the monetary experiments of the pandemic era, and now this stretch defined by record government debt and a real structural shift in global reserves, gold and silver have kept acting as a running measure of confidence in the monetary system itself. Every Fed decision tests that confidence, whether officials frame it that way or not. The metal in your hand or the position in your portfolio is just the market's honest answer to whether that confidence is holding up or slipping. That's why the next decision matters, not because of the number itself, but because of what it reveals about which way this decade's long story is heading. If you found this useful, subscribe, because we'll keep tracking these mechanisms as they unfold meeting after meeting, so you're never just reacting to a headline again.